In the closing weeks of 2025, silver prices have shattered long-standing records, surpassing $70 per ounce for the first time in nominal terms and marking a pivotal moment in the commodity as market dynamics. As of December 24th, 2025, spot silver is trading at approximately 71.48 per ounce, reflecting a year-to-date gain of over 130%. This surge eclipses the metal's previous nominal peaks from 1980 and 2011, adjusted for inflation, and underscores a confluence of structural supply constraints, robust industrial demand, and macroeconomic pressures. While headlines have sensationalized the rally, evoking notions of market failures or speculative frenzies, this analysis separates verifiable data from conjecture, drawing on global supply-demand metrics, key market participants, and inventory trends to explain the drivers behind the price movement. Silver's ascent in 2025 must be viewed against a backdrop of persistent market deficits, now entering their fifth consecutive year. According to the Silver Institute's World Silver Survey 2025, global silver demand is projected to reach 1.12 billion ounces this year, down 4% from 2024, yet still outstripping supply by an estimated 115 to 120 million ounces. This imbalance, compounded by geopolitical uncertainties and monetary policy shifts, has propelled prices higher. However, the rally is not without volatility. Silver's dual role as an industrial metal and a financial asset exposes it to both cyclical economic forces and investor sentiment. Below, we dissect the current situation, highlighting facts grounded in data while delineating areas of speculation. Historical context. From volatility to structural shift. Silver's price history is marked by dramatic swings, often amplified by its smaller market size compared to gold. The metal's all-time high in nominal terms prior to 2025 was around $50 per ounce in January 1980, driven by the Hunt brothers' infamous attempt to corner the market amid inflationary pressures and oil shocks. Adjusted for inflation, that peak equates to over $170 in today's dollars, illustrating how 2025's rally, while historic, remains below real historical highs. A secondary peak in 2011, around $49, was fueled by post-financial crisis quantitative easing and fears of currency debasement. In contrast, 2025's surge appears more fundamentally driven. Prices began the year around $30 per ounce, climbing steadily through mid-year amid tightening supplies and accelerating industrial offtake. By July, silver had risen nearly 25% year-to-date, breaking $35, before accelerating in the fourth quarter to eclipse $70. This trajectory differs from past bubbles, as it aligns with verifiable deficits rather than pure speculation. Nonetheless, some market observers speculate that algorithmic trading and leveraged positions have amplified moves, though data from exchanges like COMEX show open interest levels consistent with historical norms, not indicative of excessive froth. Global supply stagnation. Amid geopolitical and operational challenges, silver supply in 2025 has remained largely flat, with total mined production estimated at 813 million ounces, virtually unchanged from prior years. Approximately 80% of silver is produced as a byproduct of base metal mining, lead, zinc, copper, making output inelastic to silver prices alone. Higher prices incentivize recycling, projected to rise modestly to around 180 to 200 million ounces. But primary silver mines, which account for the remaining 20%, face escalating costs and regulatory hurdles. Major producing countries dominate the landscape. Mexico, leading with 6,300 metric tons, about 202 million ounces. Mexico's output has been stable, supported by operations from companies like Fresnillo and Pan American Silver. However, labor disputes and water scarcity in regions like Zacatecas have capped growth. China, producing 3,300 metric tons, 106 million ounces, China's supply is intertwined with its base metals sector. Environmental regulations and energy shortages have constrained expansion, though state-backed initiatives aim to bolster domestic output. Peru, at 3,100 metric tons, 100 million ounces, Peru's production has faced disruptions from social unrest and permitting delays, particularly at sites like Antamina. Bolivia and Poland, each contributing 1,300 metric tons, 42 million ounces, these nations round out the top five. Bolivia's Potosi region remains a key hub, while Poland's KGHM operations benefit from integrated copper-silver mining. Other notable producers include Chile, tied with Russia at around 200 to 1,100 metric tons, Russia, the United States, and Australia, where output has been hampered by aging infrastructure and geopolitical tensions, such as sanctions affecting Russian exports. Speculation abounds regarding potential supply responses in 2026, with forecasts suggesting a modest 2 to 3% increase if base metal prices remain elevated. However, facts indicate that new mine development timelines, often 5 to 10 years, limit near-term upside. For instance, projects like Pan American Silver's diversified portfolio across the Americas highlight long lead investments, but output growth has been marginal. Global demand, industrial dominance with investment tailwinds. Demand dynamics provide the clearest factual basis for silver's price rise. Industrial applications account for about 60% of total demand, projected at 665 million ounces in 2025, a 2% decline from 2024 due to economic uncertainty, but still historically high. Key sectors include photovoltaics, solar. Silver's conductivity makes it essential for solar panels, with demand surging 15-20% annually amid global renewable energy transitions. China, the world's largest solar producer, has driven much of this, though thrifting, reducing silver per panel, has tempered growth. Electronics and EVs. Silver is critical in semiconductors, batteries, and wiring. Electric vehicle production, particularly in China and Europe, has boosted demand by 10-15%, while AI data centers require silver-laden components for efficient power transmission. Other industrial, medical, water purification, and catalysis add another 200 million ounces. Investment demand, including physical bars, coins, and ETFs, has risen sharply, up 18% to around 300 million ounces, fueled by safe haven buying. Jewelry and silverware demand, at 250 million ounces, has softened amid higher prices. Jewelry and silverware demand, at 250 million ounces, has softened amid higher prices. Major consuming countries mirror production hubs. China leads with over 200 million ounces in industrial offtake, followed by the United States, electronics and investment, India, jewelry, and Germany, automotive. Speculative narratives suggest green energy booms could double demand by 2030, but data from the Silver Institute tempers this to 5 to 7% annual growth, assuming no major substitutions, supply-demand balance, persistent deficits, fueling the rally. The 2025 deficit of 115 to 120 million ounces marks the fifth straight year of shortfalls, cumulatively exceeding 500 million ounces since 2021. This structural imbalance, demand exceeding supply by 10 to 15%, has drawn down above-ground stocks, pushing prices higher. Factually, mine supply stagnation, flat at 813 million ounces, and recycling limits, capped by available scrap, exacerbate the gap. Speculation often attributes the rally to short squeezes or bank failures, but exchange data shows no abnormal short positions. Instead, the deficit is verifiable. Industrial demand outstripped supply by 200 million ounces in some estimates, with investment absorbing the rest. For 2026, Metal Focus forecasts another deficit, potentially narrowing to 100 million ounces if economic slowdowns curb industrial use. Key exchanges and inventory levels, signals of tightness. Silver trades primarily on futures exchanges like COMEX, New York, and the London Bullion Market Association, LBMA, with physical hubs in Shanghai and Zurich. COMEX eligible inventories have declined 15-20% year over year to around 280 million ounces, reflecting drawdowns amid delivery demands. Shanghai inventories hit a 10-year low in December 2025, dipping below 1,000 tons, 32 million ounces, signaling acute Asian tightness. ETF holdings, such as iShares Silver Trust, SLV, rose 18% to over 450 million ounces, indicating strong investor inflows. Lease rates spiked to 19.35% annually, a fact-based indicator of physical scarcity, though not unprecedented. Speculation about inventory manipulation lacks evidence. Audits confirm stock levels, and price discovery remains transparent. Explaining the price rise, macro and micro drivers. Silver's 130% plus gain in 2025 stems from intertwined factors: facts, supply constraints, flat mine output and byproduct dependency limit responsiveness. Industrial demand surge, solar and EVs drove 10 to 20% growth in key segments, outpacing economic slowdowns. Macro tailwinds. U.S. Federal Reserve rate cuts into 3% inflation, geopolitical tensions, e.g., Middle East conflicts, and U.S. debt sustainability. Concerns boosted safe haven appeal. Tariff and policy impacts. Fears of U.S. tariffs. Dislocated physical markets, increasing hedging. Speculation. Claims of bank kill switches failing or orchestrated squeezes are unsubstantiated. No regulatory filings indicate systemic failures. Instead, high lease rates reflect genuine tightness. Some posit AI-driven demand could push prices to $100, but forecasts like Wisdom Tree's $40 by Q3 2025, pre-rally, suggest caution. Silver outperformed gold, up 54%, due to its industrial leverage, with a gold-silver ratio compressing from 90:1 to 60:1. Implications for industry, investors, and governments. Industry. High prices raise input costs for solar manufacturers, e.g., First Solar, electronics firms, Apple, Samsung, and automakers, Tesla. Thrifting has reduced silver use per solar cell by 50% over a decade, but limits exist. Persistent 70+ levels could accelerate R&D into alternatives like copper, potentially disrupting supply chains. For miners, margins improve, e.g., Pan American Silver's Q1 2025 output rose modestly, but base metal dependency creates inelasticity. Investors, silver's rally has delivered outsized returns, with ETFs like SLV up 130%. As a hedge against inflation and volatility, it appeals to portfolios amid S&P 500's modest 20% gain. However, volatility risks persist. CPM Group's 2025 outlook warns of pullbacks if industrial demand falters. Diversification into physical or mining stocks, e.g. via GDXJ, offers torque, but leverage amplifies downside. Governments, central banks, holding minimal silver reserves, unlike gold's 70,000 tons, face indirect impacts. Higher prices strain green energy subsidies, while monetary authorities like the Fed grapple with stagflation signals. In producing nations, revenues rise. Mexico's mining taxes could boost GDP by 0.5%, but consuming countries like China may accelerate stockpiling, heightening trade tensions. Outlook for 2026, sustained highs or correction? Kitco forecasts silver could outgain gold again in 2026, with prices averaging $60-70, assuming deficits persist at 100 million ounces. Upside risks include escalating geopolitics or renewed EV or solar booms. Downside from recessions curbing demand. Retail sentiment remains bullish, with over 50% predicting silver as top metal. In summary, silver's 2025 rally to 71+ reflects a mature market deficit, not fleeting hype. While speculation swirls, data points to sustainable drivers, with profound implications for global economies. As 2026 approaches, stakeholders must navigate this evolving landscape with prudence.